Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we're continuing our short, occasional series looking back at the recent 2025 UBS European Conference. In these programmes, we're picking out a few of the key panels, themes and talking points to explore in greater depth. We kicked off the season discussing data as a differentiator, and this week we're taking a deeper dive into markets and trading. Our guide for that, it's Neil Hosie, Head of Execution Services globally for UBS Investment Bank. It's a pleasure to welcome Neil to the show. Neil, great to have you with us. And we're looking back at the recent UBS European Conference. We've got a short kind of series of programs looking at some different aspects. Markets and trading is kind of in view here. And it's great to get your perspective given your role. I know you hosted a new track, if I'm right in saying, at the conference this year. Yep. Just tell me a little bit about that. It must have been an exciting moment to kind of kick things a slightly different direction at the European Conference this year.
Yeah, perfect. Thank you. So look, I think that first things first, the conference was obviously very successful. It's the biggest event that we've held in Europe with, I think 1,300 odd clients. Now, I've been involved in a number of events globally that UBS has run. And I think historically, equally, some of the events that we've run, we have put a trader track alongside. We've done that in Asia, where I think particularly given the complexity of market structure in that part of the world, we always have a keen interest from the trading side of the business to engage around, what's happening with market structure in the region. So this was the first time that at the EMEA conference, we decided to do the same thing. So we had a trading track. So while obviously during the day, we have, huge events with lots of speakers and 400 people in attendance at most of the big events during the day with, another 200, in the side rooms watching on the screens. The traders are generally, at their desk during market hours, not able to attend, nor are they often invited. Generally, it's going to be CIOs that are attending most of these events. So we put together a smaller exclusive heads of trading track to complement the conference so that the heads of trading could get along, once the market had closed and experience, some of the best of what the conference had to offer in, a more private environment, and equally ensuring it was more tailored towards, their trading interests. So, we had Jake Sullivan, who's obviously the US National Security Advisor. We actually had him interviewed by one of our own traders, a guy called George Redman, who's ex-military in the UK, who's, as I say, one of the traders in Europe based in London. So he interviewed Jake, which was fantastic. We also had Gordon Brown, so a very private audience with Gordon Brown. He was interviewed by Simon Pan, who looks after our knowledge network. So, we were able to get, the traders in front of a couple of really high profile speakers, have them ask their own questions. And obviously, I didn't miss the opportunity for me to stand up and give a bit of an overview of where UBS is and how we're trying to help the traders navigate, this constantly evolving trading landscape.
Absolutely fascinating, Neil, and some really kind of consequential discussions. Must have been great to hear from guests of that caliber. One thing I did want to ask you about, and maybe it's because of my particular interest in media or in storytelling, was about how media itself is acting on that landscape that you've just described. I know this is one of the themes that you and your colleagues discuss. I think it's really, really interesting. How was that topic broached? Because I think, we know about polarizing media. We know it's more fragmentary. What effect is that happening? And what insights did you learn at the conference?
Look, it's super relevant. And, I had the pleasure of introducing at the main track Caddy Kay and Anthony Scaramucci, and one of the big topics from that was around the polarization that social media has created and the impact that has obviously had from a political perspective. But I think it would obviously be naive not to realize that the influence that social media clearly has an impact on the markets also. And how do we look for that? How do we navigate that? How do we ensure that we realize that that's happening? And therefore, how do we adjust the way that we trade as a group of traders, both intraday and kind of medium and long term? So there's a lot to unpack in what seems like a fairly kind of simple potential polarization. But I think there's a few key components to it. I think one, in the US, there is no doubt that the role of the retail investor has stepped up markedly, over the last couple of years, and the way that they trade, their access to tools to be able to trade intraday has obviously stepped up. So I think, there are a number of online platforms and portals where, the average age of an investor is around 31 years old. They're incredibly active across risk assets. That definitely has a bearing on what moves, how things move. And the traditional media that, if you're to go back in time, that people would be looking to determine and think about what's going to move markets has also clearly changed. So, I think that we need to be very, very aware of what is moving the markets on the retail side, such that we can help give clients guidance. Clearly, the uptick and the amount of meme stock activity is something we're very conscious of, seeing the Beyond Meats, seeing what happens with GameStop. There are, a series of companies that have had incredibly volatile moves, which have lasted for, in some cases, several days, months, that are purely being driven by highly speculative, but an amount of volume because of the size of retail investment that is moving away from what you may consider to be kind of fundamental valuation. So there's a lot of different consequences to that. There's a lot of different behaviors that we look out for. We have a retail market making business ourselves. I think we're the only sell side company that has a retail market making business. So we do look out for, and we have much greater visibility to be able to see, what is moving on the retail side of the business, and therefore help cross some of that flow to our institutional investors. At an even more basic level, I think that with the amount of drive from retail investors, particularly obviously in the US, there's a degree to which I think some of the valuation disparity that we're seeing in the US versus the rest of the world, to some degree, is also as a consequence of retail investment. That level of concentration risk that there is in the market, the stocks and the percentage that they represent of an overall index, how ETFs play into that. The market landscape has really changed. So we obviously have to be very alert, awake to the different sources of information and news flow that our clients need to be aware of, that we need to be aware of to help our clients navigate that landscape.
That is super interesting, Neil. I wonder, that's an interesting tension there, isn't there? Because I guess to a degree, if we're talking about the discourse around this space, there's a merit to shutting out the white noise, from wherever that is generated. But at the same time, it's really interesting what you say. You need to have an ear to the ground, correct? To keep a finger on the pulse, if I can mix my metaphors, to make sure you don't miss out on any strategic or tactical advantage. That's an interesting tension. And I guess in the midst of that tension and that volatility, as ever, there's a bit of opportunity if you get the balance right.
Yeah, that's right. Look, I think that the topics that clients were talking about at that trader track were, around the US and the prevalence and concentration risk. And will that unfold at some point? Will it slowly redress? Will it redress quickly? I think that when you look at MSCI World, you have 72% of MSCI World is taken up by US stocks. I think 35% is the top 20 stocks in the US. If you go back in time, if you go back to like 2007, the US was 46%. Europe was 35%, it's now only 17%. And you've got this disparity, obviously from a PE perspective, that, and clearly driven largely primarily by a level of euphoria around the AI pipeline and how that's going to manifest over a period of time, hopefully into earnings. But you've got a level of concentration in a group of stocks that are trading at a forward PE that is significantly elevated to that of the rest of the world. And I think throughout the course of the year, we've begun to see a little bit of activity in the rest of the world to play a bit of catch up. And I think that the conversation was around, as you pointed to, like, what are the opportunities? Where is valuation got to a level that it isn't warranted on a relative basis? So, seeing Hong Kong rally 30% this year, it's rallied 30% and it's still on 1 year forward PE of 12.5. Korea has rallied 60% this year. It's still on a forward PE of 13.8. China CSI 300's at 15.8 when you've got S&P at 25, NASDAQ at 34. So I think that being able to ensure that there's an awareness of what opportunities might present themselves should there begin to be just a slight shift in sentiment from what has primarily been a US only drive. So I think that, with the amount of retail activity, with the amount of ETF activity, it really has been, almost a story of US only. I think that this year you've begun to obviously see from a relative performance perspective that begin to be slightly redressed. And I think next year the dialogue is that, we could potentially see more of the same. And I think even in the last few weeks, you've seen risk assets in general, which are largely retail driven, coming off. So, historically, we as professional investors would not necessarily be looking to the crypto world. But I think as you look at risk assets and what is driving retail appetite, there's no doubt that crypto is one of those things. So to see, the fairly aggressive retreat in crypto over the last 2-3 weeks gives you a little bit of an indication as to where retail sentiment is, and I think that will ultimately drive some level of retail appetite around the markets themselves. I think that it's something we obviously keep a close eye on.
Yeah, well, it's really interesting, and lots of, I guess, the topics we're talking about, looking at how to navigate as volatility remains, as situations become ever more complex and fast changing. Hop across the pond for us, Neil, with that in mind. If we look at Europe, the picture is a little bit different here, perhaps more complex even than the US maybe. Talk to me about some of the principles that underpin the advice the bank gives to clients, and how, I guess one thing that's interesting at some of the discourse at the conference, looking maybe beyond the obvious, looking beyond the simple benchmarks to ensure, that you're still finding those same avenues of opportunity and that value that might be a little more hidden away?
Yes. So look, I think firstly, from a high level perspective, it's exciting that there has been a level of activity in Europe. Like, we've seen a real increase in volume overall, participation. That's been great in and of itself, because I think Europe has been somewhat starved of liquidity and attention for a period of time. So we've got an elevated level of interest and volume going through the European market, which is great. But I think that part of the problem with the European market and the complexity of it is that, there is market fragmentation. When you look at the way that a series of stocks in Europe trade, often the liquidity on the lit venue is significantly smaller than that is trading on dark venues. At the same time, we've seen this constant gradual push of volume coming into the close, where now about 40% of the day's volume actually trades in the close itself. So I think that what we are trying to ensure that we are able to do is to help clients navigate that landscape, whereby, they're able to judge what liquidity is good liquidity, help them judge venues for toxicity and signaling, because I think that, more and more I would expect that our client base, which since MiFID II obviously have good level of transaction cost analysis, or TCA, because they are under best ex obligations to trade with brokers that give them the best execution outcomes. But I think that often the satisfaction of the best ex obligation via fairly simplistic TCA misses that at times, while their benchmark may well be satisfied. So for example, if they are benchmarked to close and they print at close, they can kind of go home that they're satisfied that, they've satisfied the benchmark that they've been given. But ultimately, is that print that is happening with such high volume at the close a good print for them? And what is the right time horizon to be able to judge whether that is a good fill for them? So I think more and more we're going to get questions actually coming also out of CIOs, which is, is there alpha being left on the table in the way that trades are being executed? I do think that there's a conversation about the increased role of liquidity providers in the marketplace, and whether or not that provision of liquidity is beneficial if you look at different time horizons or not. So look, our job obviously at UBS is to ensure that we are doing very good deep analysis of venues, of activity around different parts of the day, on relative performance, looking at performance over many different time horizons on a relative basis to be able to help judge when do we think clients should be printing and taking the liquidity that is seen, and when should they be holding back because what appears to be a good print and good liquidity may not actually be so if you were to be, more patient or look at a different time horizon. So I think the level of complexity that we will be expected to perform to help safeguard our clients and ensure that we're giving them the absolute best outcomes possible is only going to continue to go higher. So the tools that we have to be in a position to be able to do that will continue, obviously, to be investing in. But it's certainly a very hot topic that was very much a huge conversation with all of the heads of trading that we met at the conference.
Neil Hosie, bringing us to the end of this edition of the programme here on Monocle Radio. You can listen again, explore and subscribe to the magazine at monocle.com, or discover more and find out how UBS can help you at ubs.com. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.